Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let's get into our Q&A episode today. The first question is from Rob. Rob writes, I'd love to hear your thoughts on using a one-shot wonder for share investing like VDHG or DHHF, which are two diversified ETFs. My view is why not pick one and build a position in that? What are the limitations to this? I've heard you discuss this strategy might suffice up to a point, like 300 to 400,000, but what after that? Liquidity, Vanguard going bust. What's the next best alternatives? I'd love to hear your thoughts. So I guess, Rob, my thoughts are a diversified ETF like the ones that you just mentioned. So VDHG, which is Vanguard High Growth, and DHHF, which is all growth. It's a beta shares ETF. I love these products. I think they're great. They're very simple. One trade, you get diversified exposure across all markets. It's professionally managed, so they will manage the asset allocation for you, including the amount of hedging that they might want to put into the portfolio. And it's really low cost. So it's really simple. And I think that if everyone just invested in these diversified ETFs, most people are going to achieve their financial goals. Like that is that it's going to generate enough returns or it's going to perform sufficiently well that if the strategy is going to work, it's going to work. Like that's not going to be the value sort of point. But the thing is, the more money you have, the greater the just a small difference in percentage terms has over a long period of time, particularly in dollar value terms. And I guess that's the point is that, to get financial advice and to get someone to construct a portfolio for you, it has a relative finite cost. But as your balance grows, then the fees that you pay your advisor sort of reduce in percentage terms, assuming they're not percentage-based fees. And I would say to anyone, don't pay a percentage-based fee. Pay a fixed fee, a fair fee for their work. Everyone should be fairly remunerated. But the idea is that, I've got $1 million in my portfolio and I'm paying $5,000, I'm paying 0.5% in fees. But if if all going well in 20 years' time, I've got $4 million in that portfolio or more, maybe five, whatever it is. In percentage terms, I'm not really paying very much in terms of advice if I'm still paying $5,000, kind of the point. So what could go wrong? Well, different products are going to perform differently at different stages. You don't really have a lot of fund manager risk with these ETFs. So Vanguard going bust, it's not going to be a problem. All the assets are held by a custodian. Vanguard going bust, you're not at risk. There's no counterparty risk with these sorts of investments. And because I guess the only risk is asset allocation, they're making some really poor decisions around asset allocation. You've got too much invested in this market and this market then blows up. That's really unlikely too. So I don't have any concerns. It's really how do the products work? So let me give you an example. So if you have a look at the Vanguard High Growth Diversified Fund, and I'm looking at the managed fund here, not the ETF. They're exactly the same products. It's just the managed fund's been around for longer, so it has more data, if you like. So I'm really looking at essentially VDHG here. So if you have a look at its 10-year returns, over the 10 years ending October 24, which is the most recent data I've got when I'm recording these Q&A, the 10-year return's 9.3%, which consists of 6% income and 3.3% of growth. Now, that's too much income, right? Because you're going to pay tax on the income each year. You're not going to pay tax on the growth. You would prefer to have, if you're going to get 9.3%, you'd prefer 0.3 is income and 9% is capital growth, of course. In a perfect world, we can't design that. Now, and when we review these products, as you would expect quite regularly anyway, so when we looked at this, why is the diversified fund throwing off too much income? Well, we actually sat down with Vanguard and worked this through actually with one of the portfolio managers. It's the way that they report their hedging gains. Actually, it's two things. The way they report their hedging gains, which they have now changed, and it is very technical, but essentially if there was a gain or loss on hedging, and this is really related to the international exposure portion in the fund, they had to book that either as an income or expense in the particular year that it occurred, as opposed to ascribing that hedging gain or loss to the actual underlying securities that are held in that fund. So essentially what it meant is that some of the capital gains in quotations, if you want to say that, was paid out as income. And the other thing too was BHP delisted in the UK and became solely listed in Australia on the 31st of January 2021. It was the biggest trading day on the ASX, huge amount of trading and turnover, and that caused some turnover within the fund as well, which realised some capital gains. So when you have a look at some of these funds, sometimes there's some idiosyncrasies that affect performance, and sometimes even not just headline returns, but the components of those returns. So again, if you put all your eggs in one basket and these sorts of things happen, it's a little tax inefficient. So if you're investing in VDHG over the last 10 years or its managed fund equivalent, you would have had to pay a lot of tax over that period of time. And so your after-tax return is going to be a little bit lower as a result. I thought that's a good example of sort of talking to some of these points. Now, I don't want to talk anyone out of using the Vanguard diversified products. They're good products. And I should say that they've changed the way that they account for hedging. It's really technical. They have to apply for some ruling, I think, or something along those lines in order to do it. Because the common thing for us to all think about is why wouldn't they have done it to begin with? Anyway, they didn't, and this is just one of the things. And I thought it was a really good example of, why wouldn't you just put all your eggs in one basket? So my view would be, if you're confident doing it yourself, this is really not only related necessary to diversified ETF products, but really financial planning generally. If you're confident doing it yourself, then you really should just use one diversified ETF. I think it's going to be fine. If it's the Vanguard one now, it'll be fine moving forward in terms of, hopefully, who knows what's down the track, but hopefully fine moving forward. However, the only caveats to that approach would be if you're investing a lot of money, and I would say a lot of money is, say, $5,000 or more per month, or you expect your portfolio to be worth $1 million in the next 10 years, either or of those two things, or if you don't feel confident making your investment decisions, then you probably should go and pay for advice. And the benefit of paying for advice is that you're going to have, in our portfolios, as we build them out, we probably have about 20 different holdings. So 20 different sort of evidence-based index strategies within a portfolio, and they're all doing different things, giving either us a different exposure, a different methodology, and sort of balancing out the risk that way. And as a result, what you should hopefully achieve in the long run is, better returns and better tax efficiency. But in terms of, the products that you can use, well, there's lots of non-geared products. You mentioned DHHF and DHHG or DGGR. They're all really good ungeared ones. And BetaShares has a geared diversified ETF, GHHF. I think those products are really good. So a bit of a long-winded answer there, Rob, but I thought it was worth providing that example. Okay, next question is from Ethan, a really good one. Ethan says, I've got a question regarding golden rule number 7, and this is from my book, Investopoly. And rule number 7 all relates to, if you're going to invest in property, invest in investment grade property that has, strong land value component, proven track record, scarcity. And Ethan's quoted that I've suggested that you should be targeting somewhere between 4 to 5% per annum plus inflation in terms of long-term capital growth. So Ethan, right, how does this come into effect in Perth? Should I be looking for another aspect? I live in Perth and the market conditions are mayhem at the moment, as I'm sure you're aware of. We aren't thinking of buying yet. I'm just finding it difficult to find these kinds of figures in Perth. Can you point me in the right direction? So, Ethan, it's a good question. I guess the way I interpret Ethan's question is that if we're looking for proven performance, and then what we're trying to do is find properties that are going to give us 4 to 5% growth plus inflation, which is really sort of 6.5 to 7.5%. If we assume inflation's going to be 2.5%, which it probably will be in the long term and has been historically. So that's what we're looking for. And how do you apply that into a different market that has experienced different market conditions? Well, the first thing I would do, Ethan, is I'd point you to episode 303. The blog is posted on 8th of May 2024 on the website, and the title of that blog is Melbourne Property Will Deliver the Strongest Growth Over the Next Decade. If you look at the second chart in that blog, what I've done is I've charted the median house price capital growth in each capital city, and I've demonstrated that there's flat cycles and growth cycles and flat cycles and so on and so forth. And it also includes the average growth since 1980 as well, so the long-term average, if you like. So when we have a look at Perth, and this is not a Perth-related answer necessarily, but it's an important tip or insight in terms of how you apply this sort of methodology in a practical sense. And I'll use Perth as an example just because Ethan's asked about Perth. So we look at Perth's capital growth rate since 1980 at 6.5%, which is a little bit below the eastern coast capital cities, which tend to be arranged between sort of 7.5%, right? But that's really because between 2011 and 2022, that 11-year period, there was very little growth, right? So the long-term average is a little undercooked because there's been, except for the last 2 years, the previous 11 years were terrible and grew at a rate less than inflation. So this is the important aspect here, right? We need to measure property growth relative to the market, because if the market is growing at 10% and your property's only growing at 5%, you've got some problems. But if the market's not doing anything, like it's growing at 2% or 2.6% or something like that, whatever it did between 2011 and 22 in Perth, and your property grew at 4%, you've actually done pretty well because you've outperformed the broader market. And so if what Ethan's doing is trying to find properties that have the long-term fundamentals and the history of providing strong growth, what he really needs to do is actually look at sales back in early 2000s. Because between 2002 and 2010, the median house price in Perth grew by 13.8%. Between 2011 and 2022, actually, just looking at the chart now in front of me, property only grew at 1.3% per annum, which is less than inflation. So we've had a growth cycle and then a flat cycle. So if we want to find some good quality data, what we want to do is make sure the period that we're looking at includes both that growth cycle from 02 to 2010, as well as then the flat cycle between 2011 and 2022. And so therefore, what Ethan needs to do is go back when he has a look at specific properties. He needs to really look at, okay, what did someone buy it for, say, in the year 2000? What's it worth today? And what's the capital growth rate over that period of time? Knowing that the long-term median capital growth rate is 6.5% in Perth. And so you'd want to see that the evidence is showing that it's greater than or better than the average, if you like. But it's a good question, Ethan, and it's really important then to measure performance relative to a market. And the idea is that you just want outperformance. And in fact, that was the key point in the case study episode I did on the 10th of December 2024, where I talked about a client that owns 3 houses and those houses have outperformed the median by 1 to 1.2%. That's essentially what you're looking for. Okay, next question here is from Keno. Keno's been listening to the podcast since 2018. I haven't looked at it. I think that's when I actually started the podcast. So good on you for hanging out for the whole journey, Keno. I appreciate it. Okay, so Keno writes, we're in our early 30s with a 2-year-old living in a modest townhouse 14 kilometres from the Sydney CBD. We're fortunate enough to live within 5k radius of all the important things in our life: family, friends, daycare, work. We have the ability to purchase our next investment property for $800,000, and we're leaning towards investing countercyclically into the Melbourne market in line with your suggestion in episode 303. However, with prospects of another child in the near future and a feeling that our townhouse of getting smaller, an alternative option is to upgrade our primary place of residence to a house in the upper North Shore of Sydney, while the Sydney market remains relatively flat. This means that we're compromising convenience over location, as the house in our current area is near impossible to attain on our current incomes. You discussed the concept of live investing, where you invest in the family home to secure a prime location with strong capital growth. While I have no doubt that the house in the upper North Shore will continue to grow in the long term, we are tossing up whether to upgrade our primary place of residence to secure a house in the upper North Shore of Sydney and accept that we're further away from our comfort zone, or invest in Melbourne market in the long term in the hopes that in 10 years' time, when we can sell it and upgrade our PPR in our current area. And so Keno's question is, which one would I do if I was in his shoes? So, it's funny, I guess. Sometimes I go, oh, it's a line ball. I'm not really sure. I'll have to do some calculations or so forth. But it's really nice when I've got a really high level of confidence. And Keno, 100%. If I was in your shoes, I'd upgrade the house in the upper North Shore of Sydney. And why would I say that? Well, firstly, I'm not really thinking 10 years from now. I know you are. You've sort of highlighted, well, if we buy in Melbourne and sell in 10 years' time, that might help us. I'm really thinking, in 10, what about 20 and even 30 years from now? And the risk is that if you don't do it now, you will get priced out, because the difference is, it doesn't really matter when we get on the investment property merry-go-round, because really all we're doing is investing. We've got to sort of think of or forget to some extent, I mean, it's not absolute, but to some extent what we're getting for our money. Whether we're buying a large home or an investment grade apartment, whatever it might be, forget about that. It's just, you're just investing, right? You're investing $1 million, $500,000, $2 million, whatever it is, it's a certain number. And as long as we get a certain level of capital growth and a certain level of income, the investment strategy is going to work. So whether I invest in property today or if I don't invest in property and I invest in 5 years' time, doesn't really matter too much. Just sooner the better, of course, but my returns are still going to be pretty good. The difference though with a family home is that at some point I'm going to hope to own it. And to do that, I'm going to have to use after-tax dollars. So being priced out of a particular location will then have some lifestyle implications. So if you don't go to the Upper North Shore today and you wait to 10 years, your budget is going to push you further out and further away from where you really want to be. Or you're going to have to spend more money, which means it's going to rip more money off the table from an after-tax perspective. The more money you've got to put towards your family home, the less you've got to invest. So if I was you, I'd do the upgrade now. I would then make sure once your cash flow is stable, maybe when the kids are sort of at school and expenses have leveled out, go and buy yourself an investment property. And I'd do that for two reasons. Obviously, one, to build wealth, but secondly, as a bit of a debt repayment strategy. So if you do the upgrade, you end up with a pretty sizable home loan. You want a plan B in case you can't use cash flow to repay that home loan. So that's why I'd use the investment property. I can say, well, if I even get to retirement and I've got to repay repay my home loan, I can always sell the property in order to do that. So that's my financial answer. My lifestyle answer would be upgrade now. So more living area will become necessary in the future. I don't know your situation, of course. I can only share my experiences with my clients and myself. So if you don't do it now, I think you will regret it. And having that additional land space and so forth. And also, if you're going to upgrade, if you're going to the same quality or better, in terms of investment grade quality, in terms of asset quality and capital growth, it's going to be a great investment anyway. So good question, Keno. I hope that answers it for you. Okay, next question is from Tommy. Tommy asks, do the capital growth rates for Australian property accurately reflect the value appreciation of underlying land, or are they distorted by neglecting the cost of capital improvements incurred by the owners and investors? Have we been fed overinflated returns all along? So I wrote episode 323, and the title is Warning, Don't Base Property Decisions on Data. And I talked about several things that impacted past capital growth rates and why I don't really use median data to make investment decisions. And I tend to sort of focus on individual data because that will create a more accurate picture of what, at least with some adjustments of how the underlying land value has changed. But you're bang on, Tommy. Of course, there's definitely going to be impacted by capital improvements, and it's going to be different in different areas and locations, of course. So hopefully it sort of levels out at capital city median value, but it's still going to have a pretty big impact. And so in episode 323, I talked about when I'm looking at a particular asset and property, I want to measure its growth. I need to take into account, whether there's been some capital improvements along the way. And of course, there's natural maintenance that occurs with all property just by maintaining its quality. But I'm talking about situations where you're actually improving the asset and therefore increasing its value because you're improving the improvements on that property, if that makes sense. So Tommy, you're right. When we talk about the median house price changing by, or growing at 7% per annum, of course, there's an element of capital improvement in that as well. But let's not forget it's a median value, okay? And when people talk about median values, we've got to remind ourselves that 50% did better than the median and 50% did worse than the median. And so it's just the midpoint. And I think that's the answer, is that by applying a set of principles and selecting the right asset, I would hope that you would be in that top half of the median, the bit that outperformed. And that's really the goal. So you want to buy in an area where the land value is actually appreciating significantly and it's not reliant on any gentrification, new builds, or these sorts of things. Okay, next question is from Sydney. Sydney writes, I'm currently in an industry super fund with $650,000 balance, average returns 8%. I'm in my mid-50s with teenage kids and I'm self-employed. I have a residential property worth $9 million with a loan-to-value ratio of 20%, and I have a share portfolio of about $220,000. I've researched creating a self-managed super fund to buy a commercial property, and I have consulted my accountant. The restrictions and compliance aspects of self-managed super funds don't bother me. However, I remain undecided whether moving into a self-managed super fund is beneficial, particularly given I'm heavily into property. I do wish to acquire commercial property, however. Any general considerations you can provide regarding the pros and cons of moving to a self-managed super fund at this stage would be helpful. Okay, Sydney. Well, yeah, I hear what you're saying. You've got a lot of invested in property. Obviously, your home worth $9 million with a 20% loan on that, which is a reasonable loan, but you do have a lot of exposure to the property market. And with your share portfolio and super together is about $870,000. So you've got a reasonable proportion, albeit a significant lower proportion, to shares. The problem with going and buying a commercial property is, what do you buy? If you set the budget too low so that you're not too concentrated in the super fund, you risk compromising on the quality of the asset. If you're going to do something, do it properly, which means go and buy yourself the best quality commercial property you can buy. Well, if you did that, given, you've got to put in 30% plus costs, plus a bit of a buffer, you're going to be single point sensitive, which means that you're going to put all your money into that commercial property. And now you've only got pretty much your entire wealth in two assets, your home and a commercial property inside super. Plus also the liquidity inside a self-managed super fund is problematic. And you said you're mid-50s. So you really want to be in a position where if you wanted to in 5 years' time, you could start drawing a pension from that super fund. And of course, if you've got all your assets tied up in one property, that might be really difficult to do, possibly impossible to do, because you don't have the liquidity to be able to pay the necessary pension, in which case then you might be forced to sell the property a lot sooner than you otherwise would want to. So what would I do? Well, I don't think I would do it. I don't think I would start a self-managed super fund. You said you're self-employed, so I wonder, I don't know, obviously don't know what you do, but I would explore the idea of potentially buying a commercial property if I could use it for my business. So, whatever that might look like, I don't know what your business was, but if I could go and buy a commercial property, use it as an own occupier. So that is, I'm going to run my business from that commercial property and then have the gearing outside of super naturally, which is going to be easier and cheaper to do. And then potentially look at using the small business capital gains tax concessions in the future to either move it into the super fund at that time or sell it, and you can potentially avoid paying any capital gains tax by using those small business CGT concessions, which means essentially, because it's an active asset, you get to have the general 50% capital gains discount, active asset discount by 50%, and whatever's remaining you contribute into super, and then bang, you've got no capital gains tax. So it's something that if that's available, a little bit sort of left of center here, but if it's available, it's something you should speak to your accountant about, whether you're able to do that. If you could do that, I'd probably do a look into the commercial property. I think I like the fact that you've got the shares and super, 870,000, I said, invested in those liquid assets. Yeah, I don't think I would set up a self-managed super fund because I'm going to be too single point sensitive in one asset, not enough liquidity, and that could create problems 5 years from now. Okay, next question is from Andrew. Andrew talks about, potential tax changes like the capital gains tax discount being reduced or removed. That's the standard 50% discount if you own an asset for more than 12 months. He sort of addressed whether, negative gearing would be abolished or capped or anything like that, and what impact would that have to rental yields and just generally as an investor. So I guess let's just talk about let's talk about tax changes. And in particular, we can talk about capital gains tax and negative gearing. I did a lot of work on this in 2018 and 2019, and a lot of my articles appeared in The Australian at the time, and you'll find them on my website. So any articles I've written in The Australian, I've also published on my website in PDF in case you don't subscribe to The Australian. So I've done a lot of work around this in terms of what are the impacts and those sorts of things. And there's a lot of other work around tax incentives and whether they have any impact on housing affordability and those sorts of things. I think just generally we've got to talk about tax. And I think as a long-term investor, you've got to make friends with the facts that things are going to change, right? If there's one thing that doesn't change, it's change itself, right? So it's always going to change. You just need to have a strategy that's not too tax sensitive to those changes. Now, negative gearing would be one of those elements, of course. If I've got a strategy that involves gearing, it's very likely that I've relied upon the benefits of negative gearing to justify, or at least partly or in full, that strategy. And we're not always going to do something just for the tax benefits. Of course, we're there to build wealth. So I don't think that any political party is going to be brave enough, given what Bill Shorten experienced, brave enough to get rid of negative gearing in full. Maybe you could see it being capped down the track. I don't think that's such a bad idea. I think, to sort of limit the amount of benefit that any one individual can gain from something like that, I don't have any problems with that. With regards to capital gains tax, look, even if they got rid of the 50% discount, they'd probably bring back indexation, which used to occur. You used to be able to index your cost base. There's going to be some adjustment there. I wouldn't be too worried about that either. But I just think your question, Andrew, brings up the broader point of, worrying or dealing with tax changes, just to make sure your strategy isn't too tax sensitive, so that within reason, if something changes, that your whole strategy doesn't fall apart. And you want to sort of balance things out. And that's why, different entities and different investment vehicles will have their pros and cons. No one structure is necessarily the best. And then just by building a portfolio that has diversification around those tax matters, I think helps protect you in the future. And actually, I see Andrew submitted another question very shortly thereafter. He's referencing episode 313, where I talked about alternative indexing strategies. So strategies alternative to traditional market cap indexing. And he's asked, what's your view with respect to investing in listed investment companies? Do you prefer ETFs to LICs, listed investment companies? Why and why not? Well, Andrew, I think what you've done there is just given me an idea for an episode on it by itself. Actually going back and looking over all my past episodes, I can't believe I haven't done one on passive versus active investing, but I'm going to do that, and I'll probably do that in the new year because it's a really important topic, a fundamental topic, certainly one I cover in the book, and I have written blogs in the past, but I haven't done a podcast episode on it. And that'll be the answer. Andrew, the answer is that passive investing has a huge body of evidence that demonstrates over long periods of time it will give you the highest returns and is very low cost. And so it's a good evidence-based strategies. Where listed investment companies, they've got their own challenges. Not only are they actively managed, but they're higher fees. And many LICs trade at either a discount or premium to their net tangible assets as well. So, the share price doesn't even necessarily reflect the portfolio of assets that underpin it, unlike an ETF that will almost mirror tangible assets. That's another episode for another day. And I've sort of run out of time for today, but please keep your questions coming in. And if you have any questions, comments, feedback, you can get me at questions@investopoly.com.au. And until tomorrow, bye for now.